Hi, and welcome to our next video on stock options and financial derivatives. Today we're going to look at something really easy. We're going to look at how much options are worth at expiration. Prior to expiration, it gets a little more dicey. But at expiration, we can price these pretty well. So, in fact, pretty well. Very, very well. So, just a refresher, what is a call option? A call option gives the owner the right, but not the obligation. Key, notice I capitalized it, that means it's important. Obligation to buy an underlying asset at an agreed upon price. This agreed upon price is going to be called the strike price. And we abbreviate that either as an X or, for the baseball fans who are listening, as a K. But we tend to use X for me because I was a batter and I didn't pitch, so strikeouts had a bad connotation. I'm going to use X instead. The underlying asset is usually abbreviated as an S. What is a put? We're going to look at both of these. A put option, a put contract gives the owner the right but not the obligation to sell an underlying asset at an agreed upon price. Like in a call option, the agreed upon price is called the strike price and is usually abbreviated as X or K. And again, yada, 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 we are going to use X. The underlying asset is still abbreviated as S. So, I'm going to give you a quick example of this. We know how to price things at expiration perfectly. In fact, at expiration, we know the value. It's calculable. We don't need to do a lot of work on that one. So we're going to look at it right at expiration. Once we get the hang of it, then we're going to go extend it and look before expiration. But right now, we're going to focus just at expiration in today's video. So, looking at it, we're going to consider milk. A coupon for milk, which you all know how to use. So a call option and a coupon for milk are almost identical in most ways. So here's a picture of a gallon of milk, which I found. I wiped out the name of the company that had it. If you want to Google it, it's up there. You can find it. And this gives you the right to buy a gallon of milk for $2.99. 1 gallon, $2.99, and it's only valid for a week. In this case, it was from March 25th to March 31st. I apologize, but that was when it is valid. Now, a couple things that you can pick up immediately. You would rather have a gallon of a coupon that had a strike price that was lower. So, as the strike price goes up in value, the value of the option goes down. But that's prior to expiration. Right now, we're just looking at expiration. So we're going to look at this and we're going to assume it's $2.99, the strike price, and we're assuming it is March 31st at 11:58. They're just about to close the store. So we have to exercise right now. The language here, the strike price is the milk. The price that we're going to buy it at is $2.99. The underlying asset is the milk itself, and the expiration is March 31st, as you guys probably could guess. So, we're going to look at a spreadsheet here, and we're going to do that, and we can come over here, and if we look at it, hopefully this opens. If not, I will bring this. Here we go. It is here on this other camera, if you can get it, and if not, I will bring it over. I guess it's not working, so I will bring it over here. And here we have the coupon. So, what happens at expiration if you own the coupon? You are going into the store, you have a coupon in your pocket, and you want to use this coupon. If the price of milk, and we call it spot market, just because that's what the current price of milk is $1.99, you have the right but not the obligation to buy it for $2.99. What are you going to do? You're going to buy it at $1.99. You're not going to deal with it at $2.99. So you're going to just leave that coupon in your pocket, and it's worth to you, it's worth nothing. And you'll see this is always going to be the case up until above $2.99. At $2.99 and above, you're going to start buying it at $2.99 instead of buying it at the spot price of $3.19 or whatever it is, higher than $2.99. The amount that you save, in other words, the amount that this coupon is worth, is just going to equal the maximum of 0 or S minus X. The underlying asset price minus the price that you paid with the coupon. So here we have, we plot it, and we can look down here, and if we go down just a little, we see what it looks like. This looks like, it's sort of like a hockey stick. This is the price of milk at expiration. This is the payoff, and we have something that looks like this. This is a very, very commonly used approach looking at stock options. It's the exact same thing. Let's just look, and I should note this is the payoff at expiration. We're presuming we're given this. At expiration, we don't need to worry about the profit. Next thing I want to look at, how about the liability to the store? The store gave you that coupon. They have to account for it somehow. So if the price of milk is less than the price of the value of the strike price, and I don't know where $1.99 went. I'll stick that back in there for you. If it is less than this, there's zero. The coupon stays in the person's pocket. The company doesn't have any liability. You can think of this as the amount that they could have sold it for more than they did end up selling it for. And you see it goes in reverse. Up here, it's zero. Down here, it's negative. This is calculated as the minimum of 0 or x minus s. So you might say, why would any store ever give you coupons? And you know the answer immediately. It's because they get you in the store. The ability to buy milk for $1.99, or sorry, $2.99 is important. So they get you in the store. That's their price that they are getting in. Similarly, if we go down, we can see this payoff. At expiration, the best they can do is 0. Most of the time, they're going to be losing on this coupon. So we see the exact same thing. And I'm going to pan over here, and we'll come over. If I can, I'm going to zoom in quite a bit, hopefully. Go down a little. And here we have the value of a stock option prior to, or sorry, at expiration. The value of the stock option at expiration. And what we see is, at expiration, up until the strike price, it is worthless, this line. At expiration, it starts going up in value. This is from a long position. So this is a long call position. You own the call. It is identical to what we just saw looking at the grocery store in the coupon example. If we look at the short call position, we see something pretty similar. Here's the payoff at expiration to the short position, and it looks identical to what we saw at the grocery store example with the milk. We see something that drops in value as it goes up. So you ask, why would you ever do this? Why would you ever enter into this position? Well, the short version, which we will see more next class, is that both of these focus on the payoff. Payoffs are not profits. We had to buy this option. We had to buy a long position in this stock, or in this call option. So to buy it, we had to pay something. We paid the value of the call. So the profit is going to equal the payoff minus the price we paid. Price of the call, or the coupon. But they were given to us in the milk example, so this was 0. Over here, the profit is going to equal the payoff plus the price that we received for the call. So we sold the call option, we got money in, we were short, we got money. As long as it's up here, we're making money. We make money up until this point, this is all profit. We will always focus on payoffs. Payoffs, you will never change your decision from a payoff to a profit. You'll always make it the same thing. We'll focus on that at a later date, but you'll always make the same decision, whether it's a profit or payoff diagram. We don't know the price that you paid for the call. You may have paid something different. So in our class, we will always focus on the payoff, not the profit. So there you go. Next episode coming up soon. Thank you.